Brian, it's a given that the pricing environment in the PE market right now is very, very difficult. However, the Carlyle Group has managed to invest a little less than 30% of its most recently raised fund. So what's the secret sauce to finding investments in this environment?
No, you're absolutely right. It's an incredibly robust market. We have equity markets at all-time highs, very strong credit markets. We have strategic buyers that are active, and we have a relatively benign economic environment that is giving people confidence to invest. So we're seeing all our peers are active, and the entire environment is seems to be a green light for a lot of folks. We've been approaching investing the same way we have over the last 25 years, in the last year or two, focusing on industries, focusing on where we have key global strength, and finding strong businesses that are good cash flow players, good market position players, good businesses that we think we can make better. And we've been able to take that general principle and apply it with more focus and finding deals where we can do more operationally. There's something we can do with the business post-close that hasn't been done before. So we've been doing more carve-out transactions. I'll give you an example, the ITW packaging business called Signode. We acquired that in May. We see a real clear operational improvement opportunity, an opportunity to improve purchasing and to improve overhead operations in that business. And we factored in a pretty significant cost savings opportunity into our acquisition, and we're on pace to get those savings. And we've also been focusing on doing deals where it's a business that has a more robust ability to endure through a cycle. We've been able to look and see over time that they performed well in a downturn, and we expect them to do well going forward. Finally, I'd just note that these deals, we also, as we step into them, we assume that there'll be some multiple contraction in the acquisition post-close over the time of our hold period, and we assume that in our deal at investment.
Now, the upside of the robust pricing environment is that exit activity is very strong. Is there going to be an exit cliff ahead of us at some point?
You know, the exit environment has been strong. The IPO market is good, and you know, sometimes we forget that the IPO market opens and closes. It's open today, and it has been for some time, but we keep that in mind in our investments. The IPO market is strong. The sale to strategics are strong, as well as sale to other sponsors. So it has been a good exit environment. There is nothing that we see on the horizon that says that will change because of the benign economic environment that I mentioned, the financing markets being as strong as they are, and institutions and individuals looking to invest in this environment. It feels as though that's sustainable, but it's sustainable until it's not. So we work to find, to sell our investments when it makes the most sense regardless of economic environment, what makes the most sense for our investment and the economic environment as well, factored in to some extent, and that's what we're doing today.
And industrials, which is really your bailiwick, has been a source of great strength in the PE market these days. Do you expect that to continue in 2015?
You know, the industrial environment has been a place for investment in the private equity world for many years. It's been the source of a number of deals, largely because they're cash flow businesses oftentimes that are supported by debt and leverage. It's accounted for a significant portion of our transactions as well over time. In an environment as we have today, with strong equity markets, strong credit, I expect it to continue and to continue to be a source of opportunities for us. The differentiating factor for us and probably for others is how you continue to play that. And we look for opportunities where we can benefit from our global footprint, from specialization we have in particular industry groups, and investments where we can add value and make the business better post-close.
And last point, Brian, you've participated in club deals historically, but with a tightened regulatory scrutiny on those type of transactions, are club deals dead?
No, I think club deals are not dead, and we have had good fortune and good luck with partner deals. We've done a number of them and had good success with them. There are a couple of currents that run in partner deals. If it's just a series of a large group of investors in it, and it gets to be unwieldy in the boardroom, that's a difficult situation. And if it tends to be a case where LPs don't like the fact that there are a number of particular investment firms all in the same deal where they're invested, that's a real challenge as well. Yeah. But where it works and where where it works well, and we've seen it work well, is when the firms come together, they have a similar view about the investment, and they have complementary skills and networks and views around the business that can help to make it better. And when we've done it that way, we've done very well, and we like to do those transactions. And from a cultural perspective, we partnering with management teams, partnering with strategic, partnering with other financials is part of our DNA. So we're very much open to those deals, and I expect there'll be more in time. Will there be the same size and scale as there was in 2006 timeframe? Probably not for some time, but I expect you'll see more partner deals over time.
Got it. All right, Brian, thanks very much for joining us today.
Thank you.